I would say, if I could expose myself to one metal and close my eyes towards the others, while I love gold, and I think gold ultimately is what, was what the main thesis rests on, is on gold prices moving higher. I do think that silver offers an even better opportunity. I know other people who think about palladium and platinum and other things. I do think silver is an even more clear of a thesis than other metals, and it also falls into the green revolution agenda. And so to me, it's a very compelling reason to be long the metal silver, and I continue to think it's the cheapest metal on earth.
Tavi Costa from Crescat Capital prefers gold, considering it a valuable metal. However, he holds an even more optimistic view of silver, deeming it a promising investment. Costa emphasizes that silver is affordable and presents attractive prospects for investors. Following the Federal Reserve's FOMC meeting, gold and silver prices experienced a significant uptick, reaching new daily highs. The unexpectedly dovish stance on U.S. monetary policy in the FOMC statement drove a strong rally in precious metals markets. Costa underscores silver's appeal as an investment, attributing its allure to being a monetary metal and an inflationary asset. He notes its historical resilience, particularly its performance when consumer prices are increasing. Drawing on historical data, the oil price shock of 1973 to 1979, where U.S. average annual inflation stood at approximately 8.8%. During the same period, silver exhibited an average yearly gain of 80.8%, except for the Hunt brothers' attempt to corner the market in 1979. Excluding this unusual event, silver still averaged a substantial 22% gain from 1973 to 1978, more than double the average inflation rate. Costa emphasizes the interconnectedness of gold and silver cycles, asserting that silver often takes the lead during a gold cycle. With the current gold-to-silver ratio at 80, Costa finds it compelling to adopt a bullish stance on silver. Despite this optimism, there are contrasting views from FX Empire, which suggests that silver may face challenges as the gold-silver ratio surpasses the 87.50 level. If the ratio settles above 88, there could be further upside momentum, potentially reaching 90, which might be considered bearish for silver. Before diving into TaviCosta insightful interview, subscribe to our channel and give this video a big thumbs up.
Silver is definitely one thing that comes to my mind. It's a monetary metal, inflationary asset that tends to do very well during periods when consumer prices are rising. And also, I would say that is, knowing, firsthand as we invest in the space, it's very difficult to find silver assets, and especially primary silver assets. And so, having the focus to invest in that space to me is the most important one. I've never seen a gold cycle that is not led by silver prices going higher and much higher. And today at an 80 ratio between gold to silver, to me, it's kind of a no-brainer to be very long the metal currently. And so I'm extremely bullish about this. I remain bullish for a while, and we've been very focused in buying those silver assets that I referred to. Being able to buy one of the largest silver mines in the world recently in Bolivia for one-time free cash flow. There's great opportunities out there still to be able to expose yourself towards silver, in which unfortunately a lot of people have either lost faith in the metal or just lost patience and other issues. And that's classic signs of when you shouldn't be doing that. You should be extremely focused right now, and that's what I'm doing. And so I'm very, very optimistic about metals and mining because, like I said, if everything has a price, the price of metals and mining has been ridiculous, very low and historically low in terms of valuation. So it allows you to have, especially if you are at a onset of a secular bull market for gold and precious metals overall, it makes me very, very bullish in the industry. I think most of the bearish people in this part of the market are really dedicating that view just because of the last decades of what happened. But there's particular decades in history that you want to be long metals and mining and natural resource industries overall, and those are inflationary eras, which I think it's the case here today. And so this is why I think that's it deserves much more of a effort and attention. I think that the fact that a lot of people looked at politics first, but I think the economic side comes first before politics. In other words, what happened with Venezuela and Brazil and other issues back in 2015, 2016 with Maduro. And then after that, you had the impeachment of Dilma as well in Brazil and so forth. All those issues are really created by a collapsing commodity markets. And when you have a very unfavorable period for tangible assets, that tends to be a very challenging period for leadership politically. And, it's important to remember that despite the fact that Lula was in place back in the early 2000s, the fact that commodity markets were in a secular bull market, it didn't matter what the leadership was. That market did very well despite all the issues with Lula being the president. And so this is very similar to that today, in my view. And you can see that because of the capital spending cycle of commodity producers at a all-time lows today certainly gives us more conviction that we're not in this environment of a peak of commodity prices overall.
Examining historical patterns marked by inflation, globalization, fiscal spending, and insufficient investment in natural resources, Costa argues that commodities are poised to deliver better performance than historically overvalued financial assets. The collapse of Lehman Brothers in September 2008 serves as a significant milestone, prompting a reflection on the recovery of global markets over the subsequent 5 years. Deutsche Bank's analysis of the total return performance of significant international financial assets highlights that silver claimed the highest percentage gain during this period, with gold securing the second position among these assets. This observation aligns with Costa's advocacy for a strategic shift toward commodities, suggesting that reallocating capital into this sector is wiser than maintaining exposure to equities and fixed income. The gold market settled near the $1980 level, with traders awaiting a decision from the Federal Reserve. The movement of Treasury yields lower provided some support to the gold market, as reported by FX Empire. The article mentions that if gold reestablished itself above the $1985 level, it will likely head towards resistance levels at the $2015 to $2025. Let's get back to the interview.
I think that this desperate need for companies to secure their logistics is a big issue, and it's going to create demand for reshoring, in among the G7 countries, which will be also in enhancing the demand for materials. And so as we see infrastructure developments and other things, to me, that's a huge thing, that it's going to change not only the inflation picture, but also the way we looked at valuations and other problems that we didn't have in the last 30 years. Cost of capital was going to be changing because of that, because it's an inflationary force that ultimately should drive as well interest rates to be at least higher than historical standards, or closer to historical average, which is very different than what we had in the last 30 years or so. And so the nature of companies as well, and how we manage them, and how we discount present values of businesses will change because of those shifts. And so that's an important one. But if I would mention, three factors that I think are extremely important, and one of them you mentioned there is what I call the trifecta of macro imbalances. I do think this is, we've had issues with the debt problem in the past, in the 40s, like we had in World War II, the buildup of debt. It's something we've seen in the past. But, we've never seen that in combination with other problems like the debt issue, along with the inflation problem of the 70s, along with also the valuation problem of the late 90s, and also the late 20s, which is remarkable, similar how we were seeing this, crazy level of speculation today. And in my view, this is going to become a real problem very soon. And so all those things create real political constraints for policymakers, which in my view are going to be forced to actually restore financial repression over time. And ultimately that drives really what I think it's going to be very positive for commodities in general. I mean, if we look back in history, all times that we've had inflationary periods driven by either deglobalization, labor cost, reckless amount of fiscal spending, or even the chronic underinvestments in natural resources, which are factors that we all have here in this next decade here in front of us. All those other periods in history actually were very favorable for commodities. and they actually outperformed very well relative to financial assets that today are historically overvalued. So all those things put together a thesis to me that you want to be focused on those in that part of the market, and really either shorting or just completely ignoring other parts that are, to me, noise, think stocks and even treasuries and other issues that a lot of investors are still focused on. And lastly, the 60-40 portfolios you referred to is a huge thing. Investment strategies have been overly allocating capital and effort towards equities and fixed income over 30 years or so, and now we've been, where is the next capital wave going to come from to really be redeployed into this two parts of the economy, where I don't think that there's going to be a strong case for those, and this is the whole reason why valuations have been so severe between those two instruments. And so those things are much more likely to be at risk than to present great opportunities in the near future. And so this is why I think it doesn't really it's not really an unwarranted risk to be or a premium to be taken here moving forward. So I'm of the view that you should be avoiding those types of investments in the next decade.
Commodity analysts at Heraeus Precious Metals released their 2024 outlook, and they see gold trading in a range between $1,880 and $2,250 an ounce in the new year, as a slowing economy forces the Federal Reserve to cut interest rates. European analysts expect silver to trade a wide range between $22 and $29 an ounce in 2024. How will these forecasted price ranges impact investment strategies? And what factors should investors consider in navigating the precious metals market amid economic uncertainties and potential interest rate adjustments? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.